Every crypto cycle plays out the same way. Price goes up, you get excited and buy. Price crashes, you panic and sell. Then it recovers and you missed it. Again, this isn't stupidity, it's psychology. Your brain is working exactly as designed. The problem is, it was designed for survival, not investing. This video explains the emotional cycle every crypto investor goes through and exactly how to stop letting it destroy your returns. There are 4 phases: accumulation, prices flat or recovering from a crash. Nobody's talking about crypto. Early buyers are quietly loading up. Markup, price starts rising, momentum builds, media starts covering it, more people buy. Euphoria, everyone's a genius. New all-time highs, your barber is buying, YouTube is flooded with price predictions. This is where most beginners buy. Distribution, smart money starts selling into the hype. Price peaks. Then it collapses. This is where most beginners sell. The cycle repeats every time. And most people participate in the worst order possible. Disbelief. This recovery won't last. Hope. Okay, maybe it's real. Optimism. I should get in. Excitement. This is incredible. Euphoria. I'm a genius, this goes to $1 million. Anxiety. It's pulling back, that's normal. Denial. It'll recover. Fear. It's really dropping. Panic. I can't take this anymore. Capitulation. You sell at the bottom. Anger. Crypto is a scam. Depression. You leave the space entirely. Then the cycle starts again. New investors come in at accumulation. You come back at optimism. Same pattern, different cycle. Your brain treats financial loss like physical pain. When a coin drops 30%, the same regions activate as when you touch something hot. You recoil. You want out. This isn't weakness. This is your nervous system protecting you. The problem is the crypto market uses this against you. Volatility is built in. Red days are normal. But your brain reads portfolio down 40% as danger and screams sell. Meanwhile, the fundamentals haven't changed. The project is still building. The cycle is still playing out. Your brain just can't handle seeing the number go down. FOMO is the other side. When Bitcoin is at all-time highs and everyone's posting gains, your brain activates a social threat response. You're being left behind. You're missing out. Status is at stake. This drives buying at the worst possible time. At the top, when everyone is already in and there's no one left to push the price higher. The peak is where maximum participants are. Maximum participants means maximum sellers when sentiment shifts. You bought into a crowded trade with no room to run. 4 tactics that work. 1. Define your thesis before you buy. Why do you own this coin? What's your time horizon? Write it down. When the price drops, refer to the thesis. If the thesis hasn't changed, the price change is noise. If the thesis has broken, then selling makes sense. Not because the price is down, but because the reason you owned it is gone. 2. Set price levels before emotions kick in. At what price would you add more? At what price would you take profits? Decide this when you're calm, not when the price is moving. 3. Reduce your position to your stress threshold. If you can't sleep because your portfolio is down, you own too much. Reduce until the drawdown stops affecting your decisions. 4. Stop looking at the price constantly. Daily price checks activate the emotional cycle. Weekly or monthly check-ins break it. Nobody times the market perfectly, not professionals, not people with algorithms, not crypto OGs. The people who made money in crypto made it by holding through cycles, not by trading in and out at the right moments. Dollar cost averaging removes the timing problem entirely. You don't need to call the top or the bottom. You just need to accumulate during accumulation phases and hold through markup phases. That's it. The strategy is boring. Boring strategies are the ones that work. Volatility isn't risk. Permanent loss is risk. Bitcoin dropping 50% is volatility. It's happened 6 times. It recovered every time. Bitcoin going to 0 is risk. It hasn't happened. Treat those differently. A 50% drop in a project you've researched and believe in is an opportunity to add. A 50% drop in a speculative coin with no fundamentals is a warning sign. Know which one you own. React accordingly. Comment what cycle phase you think we're in right now: accumulation, markup, euphoria, or distribution. I want to see how this audience reads the market. Next video, I'm breaking down the one thing that separates people who build wealth in crypto from people who don't. It has nothing to do with which coin you pick. Subscribe to Unbanked. The old money had a head start. You have the internet.